Thank you very much for joining us this afternoon. We're going to do a very short presentation on our results for our quarter ended September, so it's July to September, and the first 6 months, the semester of the year, which is from April to September. We normally start these presentations with a short disclaimer. I'll draw your attention to it. The agenda that I will cover this afternoon is I'm going to talk for a few minutes about the industry, which remains in crisis. I'll then cover our results, and then I'll talk about an additional initiative that we're working on, which is our strategic partnership initiative. I'll start with the industry. Industry still suffers very high impact from the volatile Euro-USD exchange rate. Here you can see for the quarter, July to September, how the exchange rate weakened from 142 on average over the period to 125. That is a decline of 11.6%. What this means is that any expense you are paying that is dollar-based, because we earn euros, automatically costs us 11% more. For the 6-month period, the semester, the rate declined from 143 to 1.27, which is 11.2%, so very similar. Fuel price remains challenging for the industry. Although you can see a slight improvement for the period July to September, the quarter, the average Brent price, which is the measurement we use in the industry, improved slightly from US dollars 113 to 110. When you calculate the same price in euros, you'll see the euro cost has gone up from 79 to 88. So although we've scored a few dollars on the Brent dollar price, once we convert it to euros, it cost us more. What I showed by way of interest is where the price was for the same quarter in 2010. It was sitting at $77. It's a vast difference. For the 6-month period, the semester, you'll see that the price did get better in dollars on average, and it was this particular little blip we had in the middle here, around July, where the price went low and then came back up. And you'll see that it went from an average of 115 to 109. But because of those first 2 slides that I showed you, where the euro weakened significantly in euro terms, although the dollar price got better, in euro the price is still high for us. And you can see it's gone from 80 euros to 86, notwithstanding the dollar price reduction. In 2010, the average for the semester was $78. A further factor that reinforces that the industry is still in crisis is to examine from the MTPA numbers what has happened to demand from Europe. And as you can see for this period, January to September, the 9 months, how Europe has dropped by 7.7% overall. And France being the biggest drop, where traffic from France or tourists has reduced by 11.9%, Germany 2.4%, Italy 25.6%, and the UK 3.8%. But I must mention, although for the 9 months Europe dropped, the overall tourist arrivals increased very slightly, which means that tourists came from other markets other than Europe. Also thought it important to show you the outlook from the International Monetary Fund, where they have taken quite a negative view of the future. They're saying that the downside risk is now even more elevated. This opinion of theirs was issued in October than they had done in April. And they have seen this sluggishness in economy starting to spread further than just Europe, but to other emerging economies as well. We previously showed you the list of casualties that the airline industry has suffered as a result of the high fuel prices and the volatile euro, as well as the challenges in the Eurozone area. And I thought it interesting to share with you this afternoon some recent, very recent, last week, additional challenges that have occurred in the industry. And the first is at one time, which is a low-cost carrier in South Africa, just filed for bankruptcy, and South African Airways has received government support to the value of $600 million, and Kenya Airways has just laid off 150 staff in an attempt to reduce costs and improve their sustainability. This is a very interesting set of information. We've seen some really unprecedented airline actions in the past period. And I thought I should share these with you, things that airlines would never have done a few years back. And again, it reinforces the fact that the industry is still in crisis. The first is that Delta, American airline, has gone and bought an oil refinery in order to reduce their fuel costs, and they believe it will save them around $300 million a year. Qantas has stopped its relationship with British Airways and has now joined with the Middle East carrier Emirates in an arrangement for the next 10 years that is basically going to see all their flights stop to Europe. Qatar has just joined the global alliance One World, and historically, or for some time, the Gulf airlines have been saying they will never become part of a global branded alliance, and they now have become one. Air France has entered into a collaboration with Etihad, and in the States we have seen rivals, US Airways and American Airlines, merging, as well as United and Continental. So again, you can see the industry. Volatile euro, the persisting high fuel prices. So although fuel prices may have reduced slightly in dollars, in euro terms they are up. The challenge of the Eurozone crisis, which is spilling into other markets as well, has led to very unprecedented actions in the industry. And all these actions are being taken by airlines in order to survive. Now I'll just refer to our results for a while. Firstly, for Air Mauritius, our challenges persisted during the past semester and the last quarter. And I just want to touch on these challenges very briefly. Firstly, growing destination competition. There is no question that as the Eurozone crisis deepened, Europeans were reconsidering where they're going on holiday. So we got competition not only because of all the other factors, but because Europeans have been re-looking at how they spend the euros. And a lot of them are going regionally on holiday, close to home, as opposed to traveling a long distance like Mauritius. We've had intensifying airline competition. Emirates have just received additional frequencies and rights to fly to Mauritius. Europe, as we mentioned earlier, the economic challenge continues and the debt crisis continues. The euro that has weakened over the period, and of course the fuel prices, although slightly improved in dollars, in euro terms are still high. What did we do about it? We've had a very robust set of actions. We developed a 7-step strategic plan in order to address these significant ongoing challenges in the company. And I'll just remind you of the 7 steps in our 7-step plan. We split them between what we call recovery actions and game changers. First recovery action was to re-look at our network. Now I just want to remind you what a network is. The network is where you fly to, how often you fly, and the time you fly. So we've re-looked at wherever Air Mauritius flies to, the frequencies, the number of times, as well as the timings. And at the same time we've addressed aspects of our fleet that tie in with it. The second step that we addressed in the business was our commercial and revenue management functions to reinvigorate them. And I'll talk a little more about them as we go along. The third was to commence a program of cost reduction and cash improvement in the business. We also then set ourselves a 4th step, which is to have a look at which assets at this stage we can work better with. and we set a target to possibly monetize one or two of the non-core assets in the business. Again, I'll refer to it shortly. On the game changer side, we said eventually by 2016-17 we should be looking to upgrade and renew our fleet. Very important as part of the entire business is to address service quality, the quality with which we deliver our service on board, at check-in and across all perception points in the company, and most importantly as well is the people. The people in the company are one of our key assets in how we harness the value and the performance of our people. I've broken the results into salient features, and what I've tried to do is to show you for each of these salient features how this aligns with the steps we've taken, the 7 steps. So the first feature I will cover is profitability, then I'll talk about revenue, and under revenue, how concentrating the network and reinvigorating RM relates to it, expenditure, improving the service quality, and lastly, harnessing our human capital. So those are the steps I will cover under the salient features. So the first most important feature for us, and I'm very encouraged today to announce that for the quarter July to September, we are reporting a profit of 1.1 billion, which is our first profit for more than a year now, as opposed to a loss for the same period last year of 6.7 million euros. Same figures, but I'll now show you also the 6 months, the semester. We've got, as I mentioned earlier, the profit of 1.1 versus a loss of 6.7 for the quarter compared to last year. And for the 9 months, if you remember the first quarter we lost 10 million, that now reduces down to 9, and last year we lost 18 for the first 6 months. So as you can see, a substantial and encouraging step forward for the company on its path to recovery. Let me take you through the other salient features and how the 7 steps contributed to them, which all resulted in the improved profitability of the business. The first is our network concentration and rebalancing. As I mentioned to you earlier, the network is where we fly to, how often we fly, and the times we fly. And we started with a suspension of loss-making routes. And we have suspended Milan, Sydney, Melbourne, Geneva and Frankfurt. Some of them were in June and others were in August. For Singapore and London, we're still flying there, but we modulate capacity according to demand. So if demand goes up and down, we either add flights or take out flights according to demand to better serve our passengers and ensure that we have the frequencies for it. As part of rebalancing our growth, we are adding flights or frequencies to Mumbai, Perth, Nairobi, Johannesburg, Cape Town, Kuala Lumpur and Antananarivo. And there you can see them. And all these flights will now have been added by the end of October. So some were, the Mumbai and Perth were in June and the rest now in October. So what you can see clearly from this concentration and rebalancing is we have stopped loss-making flights and we are adding flights which are shorter flights. So we fly less kilometers. We have a lot of seats that we're adding. The most important thing is that by rebalancing, we are controlling the cost of those flights and ensuring we fly to where we have demand and a more profitable flights. Unchanged, we're Delhi, Bangalore, Chennai, Hong Kong, Shanghai and Paris. From the end of this month, Shanghai will no longer be served through Kuala Lumpur, but in fact will now go through Singapore to Shanghai, but we'll still have our flight once a week to Shanghai. A further important aspect of the network concentration is that our passengers are now being better connected to the flights of our partners. As you know, we have a partner in Perth, we have a partner in Paris, which is Air France, we have Kenya Airways in Nairobi, South African Airways in Johannesburg, and Malaysian Airlines in Kuala Lumpur, we've now designed the network as part of this concentration and rebalancing, that our flights leaving Mauritius connect to their flights departing at their home bases and vice versa. And that's what we call O&D, origin and destination balancing, and the process we are working towards. Now, this is the 5-year projected evolution of this network concentration, where you can see Bombay will go from 4 eventually to 5 and finally end up at 7. And we are following the airline norm called 357, which I've explained over here. And that is that you start the route or grow it as quickly as possible to 3 flights, then eventually you grow it to 5, and then finally at least daily, which is daily, which is 7 times a week. And for this year, although we have reduced some flights, as you saw in June and in August on Milan, Frankfurt, Geneva, we've added flights. And overall for the year, we have a similar number of passengers. In fact, our passenger seats are 3% up year on year, but we are flying 13% less kilometers. So the important aspect of this concentration is fly less, but offer the same seats. And fly less on routes that you make losses and focus more on routes where you make profits. And that's been the core aspect of this particular initiative of our step 1. Let me show you the impact of this concentration. Here you can see for the quarter, yes, number of seats have reduced from 472 to 447, and passengers have gone slightly down, but our load factor, which is the utilization of the flights, has improved by 2.8 points from 78.7 to 81.5. So the revenue indicators that talk about profitability are improving as a result of this action. Here it is for the 6 months. You'll see for the 6 months, seats have increased slightly from 867 to 877. These are the seats on offer. Passengers we've carried went from 608 to 610, slightly better, but most importantly, the capacity utilization of what we fly, the load factor has gone up. So again, the revenue indicator is improving, which means profitability is improving. Here I've shown you passenger revenue and yield. Now yield is the average fare we earn per passenger. You'll see that revenue for the quarter went slightly down, 90.5 to 87, but yield went up. So again, although revenue went slightly down, we did stop a number of flights in August and only put flights back in October. So from a timing point of view, a reduction that comes back. But yield is positively upwards, and yield drives profitability. If we look at the 6 months, you'll see that revenue went slightly up, 165 to 167, and once again, yield, which is the average net price we get, is improving. And those are the key drivers for us. We concentrate the network, we get rid of flights that don't make profits, we add flights that make, we get rid of flights that make losses, we add flights that make profits, we rebalance it to fly less kilometers to make the business more profitable. And you can see it in the indicators. Load factors, which is your utilization of your capacity, is going up, and yield is going up. This slide reinforces this. In the airline industry, we have a measurement called PROST. Now, the kilometers we fly and that we have in our schedule are called available seat kilometers, and that's that little piece called ASK. The PR stands for passenger revenue. So if we take the passenger revenue and divide it by the kilometers, we get a measurement called CROSS, and it's the cents per kilometer we earn for every passenger. And here clearly you can see when we include fuel surcharge, the first 2 lines, and these are without fuel surcharge. The green line is last year, the blue line is this year. How our revenue that we're earning per passenger is improving for both with and without fuel surcharge. And that's a critical indicator for us because it talks about we're getting more revenue for every kilometre we fly. And that's partly the result of flying less kilometres. We stop bad flying, and by having better revenue management in the company. Now let me explain what I mean by revenue management. It's the way we control seat inventory and how we price. So we want to price competitively and also be very strong in that competition, but at the same time we also want to manage our inventory and not sell everything at the lowest price, but try to optimize our pricing. And that's what revenue management's about. Here's cargo. You can see cargo tonnage went down, and that's because we stopped some flights, but it will pick up after October. But once again, when you look at our yield, our revenue management on cargo is improving the net amount of money we earn per ton. And that's for the 6 months. I didn't show the quarter. Here's a summary of what I've been talking about. In our business, we measure some very key drivers. And those key drivers are RASK, PRASK and cost. Remember, the ASK stands for kilometers you fly, the R stands for revenue, the PR for passenger revenue, and the C for cost. And you can see, if you look at this year versus last year for the quarter, our RASK has gone up 18%, our PRASK has gone up 16%, and both are higher than the way cost went up by 15%. So very clearly, the actions we are taking, rebalancing the network, stopping bad flying, adding good flying, driving our revenue management, which is our inventory, the seat management, are having very positive results, and we can see RASK going up 18%, PRASK 16%, and cost 15.5%. And that's for the quarter. If you look for the 6 months, you see they've gone up 13%, 10.9 and 11, but in the last quarter, most of the 7-step actions we are taking are having a greater impact. The next salient feature is expenditure. For the quarter, total expenditure was 230 million euros. This is a typo here. Where's print? Not here. Let me get that right figure print. I'll look at the 6 months. For the 6 months, total cost went from 230 to 229 million, a saving of 0.9. But I showed you earlier the impact of the euro. And the euro cost us 11.3 million more for the 6 months. Had it not been for that, our total saving would have been 12.2. So the realignment of what we call our operations, where we fly and how we fly, together with cost-saving initiatives, have reduced cost for the 6 months by 0.9, but it would have been 12.2 if the euro didn't weaken by 11%, which I showed you right in the front. If we look at the quarter, there's just a typo here which we'll fix. For the quarter, costs went down 7.8. The euro had a net impact of 4.5. We would have saved 12.3. And this is our steps 1 and 3 in our 7 steps plan. Where step 1, you'll remember, is the network, where this has an impact in operations, and step 3 is our cost-saving initiatives. Then step 6 that I mentioned, which is our journey to improve service quality. I'm very pleased to announce that we have progressed very well with this initiative. To date, we've almost completed all 3,000 employees in AIR Mauritius going through an education program which is designed by Ron Kaufman. As you know, he's the Up Your Service service specialist. And from that, we've already implemented 14 quick wins in improving service, and we have a program to do even further improvements in service quality across the organization. And then lastly, as part of the 7 steps that affect that profitability is our people. We have a new head of HR. We are putting a lot of effort into reinvigorating our HR function. With our chairman arriving, we've decided with his support to restructure the leadership of the company, and we announced a new organization structure on the 18th of September, which is a structure we put in place to better support the balance of the implementation of our 7 steps. We've also implemented a company performance bonus scheme, and we are about to finalize a performance management system for the top executives and management, and then finally roll it down to all levels of employees in the company. So in summary, very encouraging results for the quarter, back to profits. Yes, the 9 months still show a loss, but our third quarter is our peak quarter where we expect to mitigate those losses a lot further. This has come about primarily as a result of implementing our 7 steps, which we're in progress with. There's still a lot more to implement, and as I showed you, those 7 steps, the key elements that have driven the improvement are concentrating the network and rebalancing the network. It's cost-saving initiatives and revenue management initiatives. I touched earlier on other steps, which are part of the 7 steps, and the one is the monetizing of non-core assets, where we've identified 3 assets that we would address going forward. Our helicopter business, we're looking for a strategic partner and are in the process of negotiating with 2 final bidders to bring in a partner that will help us reinvigorate the business. In terms of this building, the Medcore building, we for some time have focused on moving everybody all under one roof at the airport. And we are going to reopen that opportunity. If we can find a buyer for this building, we will take the money and build a new building at the airport to put us all together under one roof. And lastly, we have our hotel in Redriek's Cotton Bay, which we're not hoteliers. If we can find the right opportunity, we may consider whether we keep that particular asset or not. Step 5, I touched on earlier, that part of our program is in the future, which would be around 2016-17, to re-look at our fleet and renew the fleet. And I just mentioned that this is on hold for now as we're getting the business back to profitability, and we'll address it going forward. And that then brings me to the last item I'll cover, and that's step 8. We decided to add a further step to our 7-step plan, and as an initiative to explore the possibility of a larger or more significant equity partner, airline partner. Today we have 2 airline strategic partners in the form of Air India and Air France, and we are exploring the possibility of a larger or more significant partner as we go forward. We have followed an RFP process. We have a support advisor that will be assisting us, and we will explore this opportunity. But I must add, that's why it's called step 8. Step 1 to 7 are management steps that we are implementing to reinvigorate the business, restore it to profitability, and most importantly, create a sustainable business. Step 8 is additional. And it's an initiative that we are exploring and keeping it separate from the management responsibilities of steps 1 to 7. I'd like to end off by thanking our shareholders, our customers, our employees, Government of Mauritius, our trade and industry partners, and the Mauritian public for their support. Without them, we would not be showing these improvements, and we are very grateful for it. Thank you, ladies and gentlemen.